What if I told you there is a company that doesn't manufacture products, doesn't run retail stores, doesn't sell cars, and doesn't even lend money, yet it generates billions of dollars every year? Its product is something much less tangible: trust. Every day, governments, corporations, banks, and investors make trillion-dollar decisions based on the opinions of this company. That company is Moody's. And today we're going to break down exactly how Moody's turns trust into one of the most profitable business models in finance. When people think about financial companies, they usually think about banks, investment firms, or stock exchanges. But behind the scenes sits a group of companies that help the entire financial system function. Moody's is one of them. Founded in 1909 by John Moody, the company began by publishing financial research that helped investors understand the creditworthiness of businesses and governments. More than a century later, Moody's has become one of the most influential financial companies in the world. Let's start with the numbers. Moody's generates more than $7 billion in annual revenue. The company serves customers in over 40 countries and employs thousands of analysts, economists, researchers, and software professionals. What's remarkable is that all of this revenue comes primarily from information. No factories, no inventory, no warehouses, just data, analysis, and trust. And that revenue comes from two major business segments: Moody's Ratings and Moody's Analytics. Let's start with the one that built the company. Imagine your city wants to build a new bridge, or a corporation wants to acquire a competitor, or a government needs to raise billions of dollars for infrastructure projects. In many cases, they borrow money by issuing bonds, but investors have a question: can this borrower actually pay us back? That's where Moody's comes in. Moody's studies the financial strength of the borrower and assigns a credit rating. These ratings range from highly secure investments all the way down to highly speculative ones. Investors use these ratings to quickly assess risk. And here's the important part: the organization issuing the debt typically pays Moody's for the rating. Every time a company issues bonds, every time a government borrows money, every time debt gets refinanced, Moody's has an opportunity to generate revenue. The larger the debt markets become, the larger the opportunity for Moody's. At first glance, assigning a rating may not sound like a billion-dollar business, but these ratings influence trillions of dollars of investment decisions every year. Many pension funds, insurance companies, banks, and institutional investors rely on ratings when determining where they can invest. A strong rating can lower borrowing costs. A weak rating can increase them. In some cases, a rating can determine whether certain investors are allowed to buy the debt at all. That gives Moody's enormous influence, and it creates a powerful competitive advantage. You can't simply launch a new website tomorrow and become a trusted credit rating agency. The credibility Moody's enjoys today was built over decades of market cycles, financial crises, and investor trust. That trust acts like a moat around the business. While ratings built the company, analytics is increasingly driving growth. Think of Moody's Analytics as the software and data side of the business. Banks use Moody's tools to evaluate risk. Insurance companies use Moody's data to model potential outcomes. Corporations use Moody's economic forecasts to make planning decisions. Investment firms use Moody's research to evaluate opportunities. Customers pay subscription fees to access these platforms, data sets, models, and analytical tools. This creates recurring revenue, and recurring revenue is powerful. Unlike ratings, which can fluctuate with debt issuance activity, subscriptions generate income month after month and year after year. The result is a business that combines transaction revenue with recurring revenue. That's a combination many investors love to see. One of the reasons Moody's is so difficult to compete against is its flywheel. The ratings business generates enormous amounts of financial information. That information strengthens the company's databases. Those databases improve the quality of Moody's analytical products. Better products attract more customers. More customers generate additional data and insights, which improves the products even further. Over time, the system becomes self-reinforcing. The more the financial world relies on Moody's, the more valuable Moody's becomes. And the more valuable Moody's becomes, the harder it is for competitors to catch up. The beauty of this model lies in its economics. A factory must continually buy raw materials. A retailer must continually restock inventory. A restaurant must continually purchase food. But Moody's sells information. Once the research infrastructure, software platforms, and data sets are built, they can be delivered to thousands of customers. The cost of serving an additional customer is relatively low. That's why businesses built around intellectual property and data often produce strong margins and significant cash flow. Moody's isn't selling products, it's selling expertise, and expertise scales exceptionally well. Of course, no business is perfect. When debt issuance slows, Moody's ratings revenue can decline. Economic recessions, rising interest rates, and financial uncertainty can reduce borrowing activity. The company also operates in a heavily regulated environment because its opinions can influence financial markets. And like many information businesses, Moody's must continue investing in technology and analytics to remain competitive. But despite these risks, the company maintains one of the most valuable assets in finance: credibility, and credibility is difficult to replicate. The lesson from Moody's extends beyond the company itself. Many investors spend their time studying businesses that manufacture products, but some of the strongest businesses in the world own something even more valuable: information, networks, trust. Moody's sits at the center of global capital markets. It doesn't lend the money. It doesn't borrow the money. It doesn't invest the money. Instead, it helps the world decide who deserves it. And by doing so, it has built a business worth billions. Because sometimes the most profitable product isn't something you can hold in your hand. Sometimes it's confidence. And Moody's has been selling that for more than a century. Thanks for watching, and as always, keep investing with intention. This is The Solo Investor. Thanks for watching.